Thanks for joining our webinar today. I'm Larry Van Tassel, Director of the Center for Agricultural Profitability at the University of Nebraska-Lincoln. You can find an archive of our past webinars, as well as a schedule of upcoming webinars in our Thursday series on our website at cap.unl.edu. As farmers and ranchers prepare to close out another tax year, there are many considerations to keep in mind ahead of filing. Today's webinar will cover many of those tax considerations, including crop insurance, deferral options for livestock sales, potential law changes, and more. To present, we're glad to have Tina Barrett, Director of Nebraska Farm Business, Incorporated. Nebraska Farm Business, Incorporated started in 1976 as part of Nebraska Extension. Today, they work with hundreds of farmers and ranchers across the state, providing financial consulting services, including financial analysis, business planning, tax preparation, and more. Tina, thanks for joining us today.
Well, I'm happy to be here. All right, so it is tax planning time. As Larry mentioned, with Nebraska Farm Business, we do a full range of financial services. And I only tell you that just because one of the things that we do is the financial analysis. And I have some numbers here that I wanted to share just as we think through tax planning. I always think it's really important that we don't think solely about the tax return. When it comes to tax planning, we need to think about the management of the business as well. So this is the average farm income trend for the producers that we work with for like the last 15 years, 16 years. But I feel like we're seeing a repeat here that means that maybe some of the things that we learned in the last 5 or 6 years is something we need to be prepared for in the next 5 or 6 years. So again, this trend is index for inflation. So our 21 net farm income was the highest actual income we recorded. But when you index 2011, that year was actually higher. But it's kind of eerie how 2005 to 2011 kind of mirrors what we've seen since 17 to 21. And so one of the things that we know happened in 15, 16, 17 was a real deterioration of working capital. So this chart shows that, so that each color is a percentage of producers that fall into a specific working capital gross revenue trend. So again, working capital gross revenue kind of gives us an idea of how much working capital the operation has. Ideally, I'd like to see that above 30, 33%, but you can see that the number of farms that were either below 10% or below 0 dramatically increased from 2012 to 2017. And I think a lot of that had to do with some tax planning strategies that we did that had we done some of the tax planning better, the financials would have responded better. Luckily, we've seen a lot of that improve again in 2021, but certainly not someplace we want to go back. So I have a few lessons learned, I think, from that time frame that we're going to talk about as far as how they impact tax planning. We're going to talk about buying equipment and how financing and using Section 179 or bonus might be something you want to think about. And then, again, we're going to talk about just buying stuff, whether that's equipment or inputs or supplies that you don't need. And then talking about prepaying this a little bit. So let's go into each of those categories. So purchasing equipment is certainly something that has been an option as a way to save taxes. I always want to step back and say, okay, anytime we're buying something just for saving taxes, it doesn't make financial sense. If you're spending $100,000 just to save 30 or 40,000 in taxes on something that you don't need, whether that's equipment or something else business related that you wouldn't have to spend that money on, you're costing yourself liquidity. You're spending 100 where you could have had 70 or 60,000 of cash in your pocket if you just paid the taxes and not spent the 100,000. So that's caution number one is make sure that what you're buying makes sense for management purposes, not for tax purposes. The second part of that is if we've got to have this equipment, and we know we do, when you finance capital purchases, and use regular depreciation, it actually works pretty well to match that depreciation cost, that expense that we can use on the tax return versus the principal payments, which aren't a tax deduction, and have those two match up. So what I've done is laid out a depreciation expense for 100,000 over 8 years. 7-year life asset actually depreciates over 8 versus a 7-year principal payment. And we could do this on a 5-year life asset with a 5-year loan too. It would be about the same. And the thing that happens with taxes is if your taxable income is not higher than your family living, your principal payments, and your income taxes that you're paying, then you're going to be borrowing money in order to make your taxable income work. And so when you're matching up depreciation with your principal costs, we can wash that out and help that come along. Now, if on the other chance, we go ahead and finance that asset, but take all the depreciation in year 1, we've got all that depreciation expense, but then we've got to come up with taxable income in those future years to make the principal payment, which we can't deduct because we've already used all the expense for that. So what we saw a lot happen in that 2000 or even 2008 to 2012 timeframe is buy the stuff, write it off, and worry about paying for it later. And then the next year you buy another $100,000 asset and finance it and worry about paying for it later. And then you buy another one the following year. And so what we saw was something like this, where that depreciation expense stayed high for a few years. Then all of a sudden profitability fell off. We weren't going to be able to get the financing for more assets, but we still had all those payments that had now stacked on top of each other to where we had to make a lot of payments. We had no depreciation expense for it. And our liquidity was slipping away. And that's the kinds of things that happen to cause that liquidity that we saw in the numbers a little bit earlier. So a lot of times I'll look at whether or not to use Section 179 as to when that cash is going out. If you're paying cash for an asset, for sure, 179 and bonus is great. The cash went out, we get the deduction for it. Those kinds of things are great. It's when we start writing those things off and financing that purchase to where we have to pay for it later that can cause some management issues down the road. While we're talking about 179 and bonus, I just wanted to give you where we're at with those. Section 179 enhanced limits were made permanent with the Tax Cuts and Jobs Act and indexed for inflation. So we're not going to lose that unless Congress changes it. So there's always those two kinds of rules, those that are permanent part of the law, and those that have a sunset. And bonus is the ones that have a sunset, and we're going to see that happening very quickly. So in 22, we still have 100% bonus depreciation, but next year that goes down to 80, and the year after that 60, and it goes away. And so that is something we need to pay attention to for two reasons. There's two main times when we really need that bonus depreciation. For most operations, $1 million of Section 179 is going to cover their expense needs. But we also have that purchase limit that's at 2.7 million. So for our larger operations that are buying more than 2.7 million, especially more than $3.7 million worth of assets, they're not going to be able to use 179. So as bonus goes away, their ability to write these things off in the year of purchases is going to go away with it. And 2.7 seems like a lot of money, but the way that the Tax Cuts and Jobs Act also changed the way we purchase, have to do a trade calculations, is mean that we're putting that full value of the new asset on as a purchase and selling the old one rather than the difference. So if we've got a $600,000 combine that you bought, maybe you only paid $100,000 to trade, but that's still 600,000 of that 2.7 million that goes away. Do a couple tractors, few grain heads, and that 2.7 doesn't last real long. So be aware of that. The other time we really want to use bonus depreciation is when, for those few assets that don't qualify for 179, for farmers, that usually includes the machine shed. So our machine shed life class is a 20-year life class, and the tax rules are always so specific, but Section 179 is good for assets with a life class of less than 20 years, where bonus depreciation is a life class of 20 years or less. And those are very fine words that mean that 20-year life assets qualify for bonus and not for 179. So the ability to write off a machine shed goes away with that bonus depreciation. So if we don't have bonus depreciation and you put up a building like that, we'll be looking at spreading that out over 20 years rather than being able to write that off in 1 year. So be paying attention to that. There is some talk about already having some extender bills in Congress, but they're not getting very far. They're not getting very much traction. But that bonus depreciation would probably be something that would be on the tops of getting back in. But at this point, we don't see anything coming. So do be aware of that. All right. Let's move on and talk about prepaids, because again, a few things about prepaids that really got highlighted in that 2010 to 2015 timeframe. So there are some rules for prepaids, and not everybody knows them. So I just want to run through those with everyone. As far as how much you can prepay up to 50% of your usual business expenses. So that doesn't mean you can't prepay 100% of your seed bill, but you can't prepay more than 50% of your normal expenses. So if your gross expenses in a year are usually $1 million, you can prepay $500,000, but not more than that. Okay. It has to be an actual purchase, which means you have to have a receipt for a specific quantity at a specific price. You need to buy 1,000 gallons of diesel at $4, or you need to buy so many tons of fertilizer at a specific price. You can pay for 25% of that, but you've locked in that quantity and that price. Okay, that's important. So a $25,000 check to the co-op and say, just put it on my prepay account, that's not a deductible expense. Don't do that. You have to have a management reason for the prepaid. Again, that's not too hard to meet, but it's also important to remember that we're not doing this for tax avoidance, because you can't deduct a prepaid expense for that purpose only. But as long as there's a discount, that we are concerned about supply being there, that we're concerned about prices going up, those would all be management reasons for the prepay. And usually those things are there. So that's not too hard to get. Also be aware of dealer financed prepaids. There needs to be a separate financing company involved. So most of the large companies have a separate financing company. So we're talking about John Deere Financial, we're talking about PHI Financial. All of those things are separate companies than the dealer themselves that's selling you that input. Those are all legitimate prepaid expenses. But if you would go to your local feed store and prepay with them, and there wasn't a separate company doing that, that wouldn't be a qualified prepaid either. And then one thing I think that we haven't had to think much about in the last 10 years is what interest is costing on these prepaids. And that as you pay for these costs early, we're carrying that on an interest cost for if you're borrowing the money to do that. And that's a lot more expensive now than it used to be. So I just needed to see some numbers when I was thinking through this. So I went ahead and put just this chart together of what it costs to carry $100,000. If we're talking about 1.5% interest for a year, 100,000 is 1,500. Well, now we're looking at the 7.5%, 8% number. So now if we're talking about financing that equipment that costs 100,000, instead of a $1,500 annual cost, we're looking at a $7,500 annual cost. Even carrying that on your operating note for a couple of months on a prepay, we're talking, maybe $2,500 of additional cost that you're going to pay in interest in order to save that tax bill. So make sure that you weigh that in there, that something we just haven't had to think about for quite a while, but it's certainly becoming a real cost that is different than what we've looked at. So
Tina,
yeah,
we do have a question.
Perfect.
What do you mean by tax avoidance? And was it ever the case where you could write a check to a co-op for a prepay account and deduct it?
Yeah, so tax avoidance. So if the only reason you're paying that bill is to lower your tax bill, that's tax avoidance. Okay, so we got to have a reason for purchasing the seed, for purchasing fuel, other than tax avoidance. So again, most of the seed companies are giving you good discounts right now for prepaying early. That's a great management reason. Something like prepaying your farm insurance. There probably wouldn't be a good management reason to do that, right? Because it's going to cost you the same in April as it would today. And there's no really risk of it not being there. There's no risk of if there's a risk of that company not being there, you probably don't want to be insuring with them anyway. So that would be a prepaid where I think we would have a problem justifying the management reason for a prepay other than we're trying to save taxes. As far as the co-op goes, these rules aren't new. I think, again, it's something that people don't really know. And so, so I think it gets done a lot. And that's one of the reasons why I wanted to bring it up. But no, the deposit on the co-op account is not a prepay. But if you bought a specific number of gallons of fuel for them, or so many gallons of Roundup, or so many tons of 32 or whatever, however you want to do it, those things are okay. There just needs to be a receipt. And that's something, not that we're, there certainly hasn't been a lot of audits just because we don't have, IRS doesn't have the workload, but that's going to be one of the things that on audit that they would want to see is those receipts that show that you bought a specific item, quantity of stuff at a specific price. So something.
Another question on prepaid.
Perfect.
If you're reporting on an accrual basis, can you still exercise the 50% prepaid benefit?
So if you're fully accrual, income and expense, no, because that just goes on as an asset, does not go onto your tax return. So really prepaid is the way we're talking about. That's a cash basis taxpayer, not gonna impact the accrual. So, all right, any other questions or we're good?
We're good right now.
Okay, sounds good. Keep them coming. I'm happy to answer questions. So, all right. So the other thing I want to talk about.
Wait a minute, we just had another one come in,
perfect.
Tina, sorry.
No, you're fine.
It says property taxes are due in December, but delinquent in May and September. Can you prepay those?
Yep, those, and again, because they're due now, it's really not prepaying. That one is a little bit different where it's due now, but you have until April to pay. Where, if your farm insurance bill is due in April and you're just paying it now, that would be a little bit different. So no, I would have no problem with the real estate taxes being paid early. So good questions. Okay, so I did want to point out, as we're talking about tax planning too, that now is really a good time to pay taxes, which kind of sounds crazy. But I went back and pulled some historic tax rates just to give you some perspective on where we're at right now today. So 1981 was a pretty big tax law change. At that time, the tax rate actually went up to 70%. So if you made more than $215,000, they were taking 70% of that income. I did index that to today just because I wanted to see where that was at. So that's about 706,000. So it's a lot of income, but that same place where we were paying 70% tax then, we're at 37% tax right now. Okay, so very low. Also, in 1986 was the next major tax law change. We had a major reform then, brought that high rate down to 50,000, but that kicked in at today's dollars about 475,000. So better than 70%, but still very high rates. And those lower brackets would have kicked in pretty quickly. And I put 2017 in there just because that was right before the Tax Cuts and Jobs Act. And what we are projected to go back to in 2026, again, with no change. That's a sunsetting. These rates that we have today are sunsetting then. And so not a huge differences. They just tweak those down a little bit, but broaden those categories. So again, we were paying 39.6 at 470, which was about 575,000 today. And we're paying 37 on incomes over 620, so 630 almost today. So again, thinking back that these tax rates are about as cheap as they've ever been. In fact, I was using some of these slides a little bit later from 2012, and in there I'd made the comment that tax rates couldn't get cheaper, and that they did. So maybe I'll be wrong in another 10 years and they'll be cheaper than this, but these are historically very low rates. The other thing that's going to go away in 2025 without congressional action is the qualified business income deduction. So you might have heard that talked about as QBI, QBID, 199A, all of these different terms for this, but essentially what that is it excludes 20% of your qualified income from being taxed. So everybody that's not a C Corp who's farming is qualified for this. So any of your qualified income, we're taking 20% off right now and not paying tax on that. If your income is over 340, if you're married filing joint, there's some other thresholds because they couldn't make it easy for us. And so if your income is high, there's some other limits. But again, in the farming world, because of that investment in assets qualification, or if you're that large of an operation, we probably have some wages, isn't too hard to hit. But this is a huge difference. So I, again, ran some numbers because that's how I think is in numbers. And I put a 2017, $100,000 of farm income, what you would have paid in 2017, which again, is what it'll look like in 26 without any action, and 2022, what you'd pay on that 100,000. So in 2017, you would have gotten a standard deduction of about 12,500. You would have had personal exemptions of 4,000. Again, this is just a married couple, so taxable income of 83. You would have paid about $12,300 of income tax. I didn't put any self-employment taxes in here because those don't change between the years. But today, that 100,000 we're going to reduce to 80 because of that QBI deduction. Then we're going to take a $25,000 standard deduction. Personal exemptions are on hold, so our taxable income would be 55, and with those lower tax rates, we'd pay about $6,200. So while it seems nobody wants to pay tax, you can get a lot more bang for your buck by recognizing that income today and over the next couple of years than we will again in 26 and beyond, assuming Congress doesn't come in and extend this. And again, we don't know that, but this is still very cheap time to go ahead and recognize that income. While we're talking about things expiring, I wanted to throw a couple things in here just to say, so other things, the big things, there's a lot of things that will expire that came with the Tax Cuts and Jobs Act. A lot of the personal business things like the standard deduction and the return of the personal exemptions, we might be back to where we're talking about itemized deductions, things like that. Child tax credit will drop. Lots of those things will go away in 26. The big thing from farm standpoint, besides what we've talked about, would be the federal estate tax exclusion. Right now, each person has that 12.6 million, and it's set to drop in half in 2026. Again, not time to panic necessarily. If you're in that $6 to $12 million net worth range, but certainly something to be paid attention to as we get closer to that time frame. So we'll watch these income tax things, but also don't forget about that federal exclusion. Again, all things that are going to sunset, so we need Congress to keep it the same, not to make them go away. So, okay. A couple things specific to this year for sure. I think last year I maybe had 2 clients that received crop insurance, and this year I might have 2 clients who don't receive crop insurance. So let's go through a few of those rules again and make sure everybody's on the same page. Oops, I got some animation I want to get out of there. Okay, so you have to be a cash basis taxpayer to do a crop insurance deferral. So again, if you're accrual, we're not talking about that. You also have to usually sell more than 50% of your crops in the year following production. Also not usually too much of a problem for people to hit. There is, some gray area when you get in there if you like normally sell your soybeans, but deferral your corn, because this is an all or none election. So you either have to defer all of your crop insurance to next year or none of it. That could be a real issue for a lot of producers this year that had, upwards of $1 million in crop insurance, is we have to decide which side of that year we need to have that income on. So certainly some planning involved in that, as we got to pay attention to it. The other thing, I've got the crop insurance price guarantees up there for corn and soybeans, only because the soybean price fell, which means that part of your soybean payment could actually be due to price loss. And the way that the law was written, and again, this was long before revenue insurance ever existed, but the way the law was written is that it has to be crop insurance that was paid due to the destruction of crops is what you can defer. And so if part of that soybean payment this year is actually due to price loss, that portion we can't actually defer. And sometimes we can actually use that to our advantage to get around that all or none election terms, just because if we can't defer the price loss, maybe that helps us have a little bit of income this year and deferring the crop damage part to next year. So certainly a little bit complicated to go through much examples today, but might be something to talk about with your tax preparer as far as being able to make that calculation as to how much was revenue loss, how much was crop loss. So crop insurance isn't anything new, and unfortunately, the livestock deferrals due to drought is not something we probably haven't dealt with for too long, but I wanted to go through those rules as well. So with livestock, we have two options. One is a 1-year deferral for any kinds of livestock. So we can make a calculation and move that forward. The other, we have a 4-year deferral for a draft dairy and breeding livestock. So we'll talk about both of those options. In either case, you have to be a cash basis taxpayer, and farming has to be your primary business in order to use these deferrals. And you may need a county disaster declaration to prove that there was a drought, but for all but 4 counties in Nebraska, that's not a problem. I have a map for you here in just a minute, but let's talk about the 2 deferral options. So the 1-year deferral, again, allows you to defer the excess livestock, either feeding or breeding, to the following tax year. So that's not as easy as saying, I sold 1 calf crop in January and then I had to sell the next one in October because I didn't have feed to keep them over the year. So we can't just take that check in November and put it in the next year. We have to calculate your average sales over the last 3 years, and then you can defer the excess over that. So a little bit of calculation there. You don't have to have a federal disaster declaration to do that, but you do have to prove that there was caused by drought. But any federal assistance that they offer would qualify for that. So, CRP release, roadside haying, any of those kinds of things would allow you to qualify for that. On the 4-year deferral, we can do 2 years with no federal disaster declaration. We need 4 years. To do the 4 years, we do need that disaster declaration. It allows us to take the gain on the sale of those replacement animals. You basically take the gain on the sale and reduce the purchase price of the replacement animals. In that 4 years, it does have to be like kind. So you have to replace beef cows with beef cows, dairy cows with dairy cows. But if after 4 years of continuous drought, it's still not feasible to replace those animals, we can then at that time reinvest in non-like property. So we can take beef cows and buy dairy cows, or we can take beef cows and buy a tractor, but it doesn't work for land. So we can't get too excited about that. So again, it's been over 10 years that we've had this the 4-year extension. So they do use the National Drought Mitigation Center to monitor that. And it includes, if the county that you're in or the county that's surrounding yours would be affected, then you're eligible for this deferral. So I did, like I said, pulled the map. Most of the United States, this would be the disaster declaration for crop year 2022. Anything south and west of us is definitely good. I did zoom in just a little bit on Nebraska. So it's just those 4 counties in the far southeast that is not either in a county that's been declared a disaster, or the yellow ones are ones that are continuous to a county that has been declared a disaster. So as long as they're touching, they get to be included in that. So pretty much at this point, unless you're in those 4 counties in the far corner, you have automatic approval to use any of these livestock deferrals. And if you're in those 4 counties, we might still be able to use some of those other qualifications if you felt like you had to sell due to drought. The other thing is, if you live in Nebraska City, but your cattle are in Custer County, you can still use that because that's where the cattle are located. So don't think about, or just keep that in mind too. The 1-year deferral is a separate election for each classification of animals. Don't need to spend a lot of time on some of these specific things, but you could, if you've got hogs and cattle, make a different election for each of those. The one thing I want to point out, though, is that just because you have the option to defer it, maybe isn't mean it's the best choice. Okay, so again, we've got these low tax rates today, and depending on what kind of animals you have, that gain may be used to offset an expense that could get you both a self-employment and an income tax savings while only saving you income taxes. So I've got some examples I just want to run through. So this is raised breeding livestock, and I just got sale of $21,000, just a you sold an extra 21,000, we could defer that, recognize no income in 22. And then in a couple of years, we would get a deduction if you bought back 22,500, bought back a little bit more than your gain. So you get a little bit of tax savings from that. But pretty much wouldn't affect anything. But those raised breeding livestock are subject to a 0% capital gains tax if your normal income is in the 10 or 12% bracket. So you could be deferring a 0% tax and then giving up a deduction that could get you $6,000 in savings in the future. Okay, so depending on where your other income is, you might not actually want to defer it, might want to pay a little bit of tax today and get a big deduction in the future. That works perfectly with raised breeding livestock. With purchased breeding livestock, it's still a little better savings because we're saving that self-employment tax in addition to the income tax, but you're not going to see as big of a difference in that purchased breeding livestock as you do in the raised. Okay, just because that has to be ordinary income as depreciation, recapture, and all of that stuff. So just really think through that. If there's other things you can do to control your income this year, like prepaying some expenses, using income averaging, all those kinds of things, maybe we'd rather do that than actually go through the work of the deferral. So, all right, so I wanted to make sure I left time to answer questions that you had out there. So Larry, I don't know if any more questions have come in while I was talking.
No new questions at the moment.
Okay, well, if you've got questions that I didn't hit on, feel free to use that question box or that chat box, and we can certainly get those answered. So I see one came in. Yeah, so a fire was in August of 21, sold a breeding herd in March of 22, and the calves. Yeah, so there's going to be some casualty loss rules due to the fire. So the casualty loss rules are very different. So if you lost fences, those kinds of things. So anytime there's a casualty loss, whether it's a tornado, wind, any of those, so wind knocks over a pivot, fire takes out fences, all of those things moves into a different world. So those, we can take that insurance proceeds and reduce the cost of replacement. So if you get $10,000 from an insurance company to replace your fences and it costs you $12,000 to do it, then you have a $2,000 fence expense that you can deduct. If it's a pivot, we're going to need to depreciate that. But we don't have to do the sale of the asset and the full purchase price like we do with a trade of normal assets. I do think that casualty loss, well, regardless, again, if you're in those areas that are the drought, you should be, even if the fire was what caused the lack of feed, you should be able to still use those issues as a deferral if you needed to do that. So yeah, certainly look into that. Look into income averaging and some of those other options as well. But I think you'd be where you're at. So.
All right, Tina, we have a question here. Could you explain income averaging? I was told you could average over 3 years.
Yeah. Yep. So income averaging is actually just like a super cool tool that only farmers get to use. And it takes a high income year and you can average back into 3 low income years. So say your income was $100,000 this year, and in the past few years, you were only having 10,000 of taxable income. You could take, you have to take it back evenly. So you could take, say, $60,000 from this year and put 20,000 in each of those previous 3 years. You don't have to amend returns. We just do it all on this year's tax return. But we basically go back and pretend like we tax that income in those years. And so we recalculate the tax based on the brackets from each of those years and come up with what the total tax bill is. So it can really save if you've got losses, because we can carry income and offset those negative years. It can save if you've got capital gains income, like the sale of a raised breeding livestock that we can use and get at cheap capital gains rates. If your income is consistent year after year, it doesn't do us as much good. but it's certainly a great way to potentially save some tax. That is also an income tax calculation. So it doesn't, like your self-employment tax calculation is still going to be calculated on all the income that you recognize this year. So sometimes income averaging can save us a lot of income taxes, but the self-employment tax can still come in and kind of get you. But certainly a really valuable tool that we in the farming world get to use and nobody else does. So.
All right, Tina. Another question. I plan to purchase a grain bin and use section 179 to depreciate it. However, can I take any down payment off my taxes this year as an expense, even though the bin won't be placed in service until 2023?
Yeah, that's a really good question, and one I probably should have covered just because of so much of that placed in service question. So any asset that is depreciated is not allowed to be depreciated until it's placed in service and ready for use. So that means if you, even if you paid cash for a combine that's going to be built next summer, can't deduct it because it's not placed in service. It's not available for use, and you can't do that. So the same thing with the grain bin. If it's not ready to store grain, then you don't get to deduct any of it until that time. So nothing on the down payment can be used this year. Have to have that bin ready to put grain in it before you can do that. Now, again, that doesn't mean that you're going to use it. So you might have a pivot up right now that you don't have any intention of using for 6 months, but as long as it can and it's ready, it could make a turn and water, then you can deduct that now.
Okay, Tina, can IFP, NAP, or RFP, in other words, rainfall insurance, be deferred to next year?
I would have to double check on that, but it does not fall under the crop insurance definition. I don't think, but I would have to double check on that and do some research, and I don't know that off the top of my head.
All right. Any other questions out there? All right, it looks like that's about the end there, Tina. So thanks to everyone for joining us today. A recording of the webinar will be posted at cap.unl.edu, where you can also register for other upcoming webinars that will be scheduled after the new year. We'd greatly appreciate the feedback on the brief evaluation at the link in the chat box. This helps us tell us how today went and inform us for future webinars. Thanks again for joining us. And Tina, I think we do have another question that just came in there.
Yeah, saw a couple sneak in.
Yep.
So the first one's a family of 5, put $80,000 of income and use all the premium tax credit for health insurance. The maximum you can have without paying it all back. So we'd have to go back and look up the federal poverty rate. So if you just Google that, you can see that, and it'll tell you what your family of 5 federal poverty rate is. You take that times 400%, and that'll tell you where you're at. Now, the cliff with the health insurance is not there like it was pre-COVID. So during COVID, they put part of this emergency relief in there and put in a rule that said you didn't have to pay more than 8.5% of your adjusted gross income for health insurance. And rather than if you went $1 over that 401% of federal poverty rate, and you have to pay it all back. So they did get that extended in one of the tax bills. So that cliff is no longer there. And this is a permanent, so we don't have to worry about this expiring. So the most you'd have to pay back is what's over 8.5% of your adjusted gross income. But again, yeah, just Google federal poverty rate and take that times 400%, and that should tell you where you're at, to where you'll be able to keep most of that premium tax credit.
All right. The next one, what are the best ways you've seen to exit farming with 500K deferred grain sales and all expenses already deducted?
Yeah, people often say that it's hard to get into farming, and I think it's harder to get out of farming, partly because of all these things that we've done for years to defer these taxes. There's there's some kind of creative strategies, and it really gets very specific. There's things like charitable remainder trusts that would allow you to contribute that carryover grain and spread that tax liability out over a longer period of time. Lots of rules. It's a complex thing, so you definitely need some experts who know what they're doing to help you with that. But that might be an option. That doesn't work good if you've got a $500,000 operating note because the bank wants their money back. So, again, that works if you don't have a lot of debt. You might look at some retirement plans. SEP retirement plans are easy to do. You can put 60,000 a year into those. Again, it's a tax deferral. It's going to come back at you someday, but it gives you ability to spread that out. There's also some more complicated defined benefit plans, things like that. That again, those are going to be expensive to administer. We're talking, $4,000 to $5,000 to set them up, $1,500 a year to administer. So not cheap. But if you've got a lot of extra income, that might be an option. But there's really no way to get out of these taxes other than death and giving it away, right? Those are really the only two ways that we can get out of taxes. So, and it's hard when we don't think about a lot of these things. I always ask my clients to give me a 5-year heads up as to when they think they're going to be done so that we can spread that liability out, do a lot of these plannings. But, if in 2 weeks you're going to be done farming and you've got a lot of carryover grain, that's, not a lot we can do other than, again, potentially looking into some of those other fairly complex but reasonable things to do. So,
All right.
I wish I had a perfect answer on that one.
All right. One other, did I understand right that a pivot needs to be in place in order to deduct?
Yep, everything that any capital purchase has to be placed in service, ready and available for use. So that means not in a pile at the edge of the road on the field. It should be, up, ready to make a circle, able to do that in order to deduct it this year. Same thing, if you order an equipment, it's certainly creating issues with the backlog in equipment, in knowing that it's so hard to get a hold of that equipment. You should have it and be available to use. I do have some colleagues who will argue that if you're buying a used piece of equipment from somebody in Colorado and you paid for it and you just haven't gotten there to pick it up and bring it home yet, that it is ready and it is available for use because you just have to go get it. You just haven't done it yet. Others will argue that it needs to be on your farm and ready to go. But certainly if it hasn't been made yet, that's a no-go. If it hasn't been built, those things are certainly not deductible yet. And then the follow-up question I usually get to that is, how will they know? And that is a good question. But if your purchase agreement doesn't have a VIN number, it's a pretty obvious that it wasn't ready. We've got things with Google Earth and the ability to look at satellite pictures, especially in a situation of a pivot or a grain bin or a machine shed where they can see what was and wasn't erected at different times. So there's more and more of those options that are available to check that stuff than what we used to have. So again, pay attention to that.
All right, Tina, that looks like it. Oh, here's another one. What are the average living expenses now?
Yeah, we've been running right at 100,000 the last 10 years. So it's actually kind of been interesting that that's leveled off, but it's still 100,000 plus taxes. So that's where we're at.
Great question. All right. Well, Tina, thank you so much. Appreciate your spending time with us today. And again, to our audience out there, appreciate it. And if you will fill out that survey, we'll take your opinions at heart. And also, if you've got anything that you would like to see on a webinar, we're all ears. So everybody take care and have a happy holiday.